RMB. So for company, the two options are you can actually open a resident account in offshore, or you can open a non-resident account in country in China. But I think that if you compare, so when you decide whether you want to open a resident or non-resident account, I think I think the preference that I would seem to recommend would be to have the account offshore. Number one, I mean, like it or not, it's trapped liquidity, right? So you rather have the liquidity out, and with the liquidity outside of China, you can tap on it. You will be bound by regulation. So if you go through, right, you'll be bound by Chinese laws versus your Singapore or Hong Kong laws. You need to get an approval first before you even open a non-resident account. Bank interest is regulated. In one of the slides later, regulated when I mean in the savings rate, you'll get 0.36%. Okay, that's a regulated rate. But the offshore market, because there's a demand for the RMB, the banks will be pricing up, right? So, for example, I'll just give someone we had conversation and someone was just saying in the market, in the consumer market, someone was pricing 70 basis points, right? Citi on the corporate side, on average, indicative is about 50 basis points. So all this is to just give you an indication, the onshore market and the offshore markets, there's already a differential because there's demand for the RMB currency offshore. But as a company, you make a decision whether a bank interest income is subject to withholding tax. So you make the decision whether you want to keep that money offshore or you want to pay that cost of withholding and still keep it offshore. So these would be considerations you need to make. I think the other thing is overdraft. You can't go into overdraft. I think that's one of the key considerations when you decide whether you want to open that onshore or offshore account. This is what I do day in, day out, which accountants may not be familiar with. Accountants would deal with treasurers. So I'll just put in a picture, right? If you look, oh, I'm so sorry. Let me see, what's this? If you look at this piece of it, let's assume you have two accounts. One account in Singapore, an RMB account, right? The purpose of opening the RMB account is for trade settlement. Therefore, assume this is a collections account. So someone from China would be paying into this particular account, okay? Right, so very straightforward. So imagine that you have a collection of RMB accounts. On its own, today, let's just say you and I are a consumer. If I keep $10,000 in an account, I'm not going to get any interest because the bank won't pay me $10,000. But if I club all my money together, $1 million, I'm pretty sure the bank will pay me interest on that $1 million. Same concept. So we club all your RMB accounts together, and we call it a cash pool. I pool all the funds together, and because of $1 million, I'm going to get a pickup on that. So think of that concept, right? So that's your RMB. So imagine, as a company, you may have US dollar requirements you need to pay out. For that particular day, you may end up tapping on your overdraft. Under normal circumstances, if you don't have the RMB account, you have to tap on your overdraft, pay a prime rate, and then pay out in US dollars. The whole idea of this is because I now have RMB sitting in Singapore, I'll just do a spot FX, and I'll just pay out. So immediately there's a cost savings. I'm not paying overdraft charges, right? You've just entered into an FX to pay out. Okay, let's take the story a bit further. What I do day in, day out is to advise companies like PepsiCo, the MNCs. I automate the whole flow for the company. This is where most treasurers are at this stage, where on the Singapore side, it's self-funding already. So assuming that you have an Australia entity in Australia, it needs funding. We will automate that funding for you. So you tell me, hey, Citibank, every day I want you to empty my account in Australia. So if it's money in the account, take it to Singapore. I'll concentrate everything in Singapore. If it needs money, Singapore will fund. So this account here will fund this position. So all you need to do is do the FX. So number one, you have taken the trapped liquidity out. You've used this trapped liquidity that's out to actually fund your working capital elsewhere. So this is a typical structure that can arise. The other type of structures that one may commonly see, I think as accountants, as a bank, we rely on GAAP, we do GAAP reporting. So we can net off our books in this particular notional pool structure by relying on cross-indemnity and set-off clause, right? So I think under IFRS, there's actually special provisions that allow us to do that if you meet certain conditions as a company. So if you enter into such a structure, it gives the company the ability to net off on their balance sheet as well. So from bank's perspective, I can do it because I've got those legal clauses. And if the company works with their lawyers and subject to the tax people yourselves approving and accountants, you may be able to net off on the balance sheet too. So this becomes an attractive solution for some companies, a notional pool where you don't physically move funds. In the previous example, you move funds and therefore you enter into an intercompany position. Some companies don't like that, right? So in this structure, notice, I think this flow remains the same where you are the collections flow. Note that there's no FX here because what happens is in this particular instance, the bank using our system has notionally converted for you. There's no FX exposure here. So I know that you have a payment that needs to go out. Notionally, for example, at 4 o'clock, we go to Bloomberg, we pull that rate. It's a transparent rate, and they say, okay, then we notionally convert to say, okay, this entire pool has $20 million, and there's a payment going out of here. There's no money in this account, but there's funds in this account. I will allow the payment to go out. Okay? So this is how, in a different angle, you can actually add on RMB accounts in the structure to tap on, to increase your working capital liquidity. I'm definitely no trade expert, but these are the range of trade services that the bank offers. Again, just to the point that treat RMB like any other foreign currency. So increasing, we have offered the complete suite of services that Citi has and apply it to RMB. So that's the message I want you to know and take away. I think with that, I would end my presentation. Maybe we can, I think a Q&A will probably be more constructive. Otherwise, it's just a lot of facts that I'm just dumping on. Thank you.
Thank you, Ms. Ong. Now we will commence on the panel Q&A. Will all the panelist speakers take your seats, please? The panelists are from the left, Ms. Charles Gong, Mr. Chen Yi-wei, Ms. Ong Shi-wei, Mr. Lim Li-ming, and lastly, our fifth panelist speaker is Ms. Anita Loh. She's the head of trade, payments, and collections from Citibank. She has over 11 years of banking experience, spanning roles in relationship management, sales, product, and product management. She has also spent 5 years with Citi China, building the commercial bank portfolio from scratch. So right now, if you have any questions, you can direct it to any of our panelists.
I think the presentation before the break, some of them actually are quite relevant to us. I observed especially the presentation by Charles on the tax exposure. When you have Singapore's SPV, investment holding company, to hold your investment in China. So based on the case study, he has presented the 3 case study. One involved US, then the Singapore and Hong Kong. Yeah, it looks like even you use a holding company to hold investment in China, even if you were to sell your shares in your holding company, which is a Singapore company or offshore company, to another investor, China now actually have the rights, or they are exercising their rights to tax. Yeah. So I think this is because in Singapore, I think most of our Singaporean companies, when we invest into other countries, need not be China, it can be China, India, or elsewhere, in order to manage your country risk, your investment exposure.